Hello and welcome to Portfolio Matters. In today's episode, we will be providing a brief guide to IFRS 16 lease accounting for investors. Before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Okay, Keith.
Thank you, Richard. Okay, IFRS 16 lease accounting. Now, we are currently looking at the UK restaurant group, Comptoir Group. But in order to understand the accounts of any company that has a large number of lease commitments, you need to understand IFRS 16 lease accounting, which has come in the past couple of years and really complicates the job of analyzing financial accounts. So Richard and I have had to educate ourselves on this issue. Now, what does IFRS 16 do? Well, it aims to put lease liabilities into the accounts in a standardized way and report clearly the timing and amounts for lease payments. And what you need to know is that IFRS 16 turns all operating leases into finance leases, and it creates on the balance sheet two separate items. It creates an asset called the right of use asset, which is equal and opposite to the lease liability. And over the lifetime of the lease, both the right of use asset and the lease liabilities decay as the rent is paid on the lease. But the right of use asset is depreciated linearly, and the lease liability falls in line with its net present value, which in turn is a function of the interest rate at which the company can borrow. And so over time, the value of the right of use asset and the lease liability deviate from one another, and that difference between the two must be put through the P&L account. And the net effect, what you really need to know, is that IFRS 16 will tend to flatter EBITDA and operating profits as rent no longer goes through the accounts of the above the operating line. They are accounted for as financing costs and interest paid. And you will see that and understand that as we go through some examples. Okay, so IFRS 16. So obviously a lease is a liability. And the problem was, under the traditional accounts, companies with very large lease commitments did not have to report those in any way in the annual accounts. And so investors could be surprised by these hidden liabilities. So the aim of IFRS 16 is to bring those liabilities into the accounts. So, but a lease is also an asset, and it gives you the right to use an asset for a certain period of time, and that creates this right of use asset, which is equal and opposite to the lease liability. And the value of the right of use asset is calculated as the initial amount of the lease liability plus any payments made prior to the commencement of the lease minus lease incentives. And that's important in the last year when there have been lots of discounts to leases and for companies such as restaurants, and they've negotiated their lease commitments down, plus any other costs. Now, each year, as rent is paid, the lease liability is paid down and the right of use asset is depreciated. Okay, so let's work through an example. let's imagine a company which has initial cash of £100. It's got revenues of £300 per annum, costs of £100 plus lease liabilities of £100, so rent of £100 for 10 years. It's signed a lease for 10 years. Its borrowing costs are 10%. Now, under the original system, this is how the income statement would have looked. Have revenues of 300, operating costs of 100, rental expense of 100, giving you EBITDA of 100 and net profit of 100. And that is the same every year. The balance sheet would look like this. So you start off with cash of 100. Every year you have profits of 100. And so your shareholders' funds grow by £100 per annum. Your retained earnings grow by £100 per annum. But notice the lease liabilities do not appear anywhere. Okay, so how will the accounts for that company look under IFRS 16? So the first thing you need to do is calculate the net present value of the lease liability. And this can be easily done using a function in Excel. Essentially, you put in all the payments and the discount rate and a number pops out. So for 10 annual payments of £100 at a discount rate of 10%, has a net present value of £614.46. So on the balance sheet, you create a right of use asset of £614.46 and a lease liability that is also of the same amount. And this is how you treat those two items. So you're paying rent of £100 per annum. In the first year, at the start of that year, you have a lease liability with an NPV of £614.46. You then have to split the payments into two separate items. You have an assumed interest payment, which is equal to your interest rate, which is 10%, multiplied by the value of the lease liability at the start of the period. So that is £61.45. You then have an assumed principal repayment, which is equal to your cash repayment minus your assumed interest. And so in the first year, that is £38.55. Now, over time, as the NPV of the lease liability decays, so the value of your assumed interest falls. And you'll see on this line, between year 1 and year 10, your assumed interest payment falls from £61.45 to £9.09 in the final year. And your assumed principal repayment rises in compensation. So it goes from £38.55 in year 1 to £90 in year 10. Now, those numbers then will affect all aspects of the financial statements. So if we now look at the income statement under IFRS 16, we have revenue of 300, we have operating costs of 100. Now, EBITDA is now 200 because we're not accounting for rent anymore. So you need to be very aware that under IFRS 16, the EBITDA of companies with big lease liabilities will be flattered, and you should be treating EBITDA with caution. You then have an interest expense of £61.45, and you also need to depreciate the value of the right of use asset. Now remember, the initial value of the right of use asset was £614.45, and you depreciate that linearly over 10 years. So the depreciation is equal in each of the 10 years of the life of the right of use asset. And you'll see the interest expense, on the other hand, declines every year in line with our accounting treatment of the lease and the assumed interest. So this line, the assumed interest, equals the interest expense. And the leasing cost you put through the income statement each year is the sum of rows 4 and 5. So in year one, it's £122.90, and then it's going to decay over time. So that means your net profit is no longer simply £100 every year. It is going to change over time, and your profits will actually be lower in the early years of the lease, because your interest rate expense, your assumed interest rate expense, is higher, and then it will be higher in the final years of the lease. So you need to be aware that companies with large lease liabilities and high borrowing costs will tend to have depressed profits in the early years of the lease and higher profits in the final years. And this is the cash flow statement. So starting off with the operating profit, you need to add back the depreciation because that's a non-cash item. But then you'll see on the cash flow statement, there is a lease liability adjustment, which does not go through the P&L. And by subtracting that, you get back to your cash flow of 100. Now, the lease liability is a non-cash item, and effectively, because you've written down the value of the lease liability every year, and that increases the assets of the company, you then need to write that down. Is that correct, Richard?
Yes, that's correct, please.
Okay, then if we look on the balance sheet, you see the right of use asset has a value of £614.45 at the start, and then is depreciated linearly by £61.50 a year, whereas the value of the lease liability declines in line with its NPV. The net impact, the difference between the two, is what goes through the P&L. The next two tables just show you how that all adds up in an accounting way. So it has the balance sheet, profit and loss, and cash flow on the same table, and accountants will understand this. And if you want to spend some time, you will see how everything reconciles. So this is under the traditional accounts, and this is under IFRS 16, and you'll see everything adds up. And if you don't understand what we've talked about so far, spend some time examining this table, and hopefully it will become clearer. If you have any questions, please get in touch on either via the email or via our Discord. So in conclusion, IFRS 16 has put leases onto the balance sheet, but it has created essentially a lot of imaginary numbers in the form of interest payments and depreciation, which then need to be added back both through the P&L and the cash flow statements, making them more difficult to interpret. The bottom line is, if you stick to the cash flow numbers, you will be fine. But if you're looking at the income statement, you need to be very careful about EBITDA and operating profits for companies with large lease liabilities. Richard, your thoughts?
Yeah, thanks very much, Keith, for trying to explain what is quite a complex subject in a simple manner. I think using the elementary numbers is very a very good way of displaying it. The problem, of course, comes when you have these, as you mentioned, these companies have a lot of leases in, there's a lot going on, and that's very hard to track through. And I think your point that the cash flow is something that is very difficult to manipulate. And if you really want to find out what's going on, look at the cash flow in companies' accounts, as well as the profit and loss account, the notes, and the balance sheet. EBITDA, I mean, these days companies chuck in all sorts of items, don't they? One-off items that are really recurring items, and the EBITDA figure I think is very much designed to flatter and produce, as they call it, is it the adjusted earnings per share? I forget which way around it is. Anyway, the better earnings per share is the one they use EBITDA for, and then all the other stuff goes under the line. So yeah, go off the cash flow, and it is confusing. And I have to say, the minds of people who created this accounting process must have been quite convoluted.
Okay. And on that note, I hope you all managed to follow us as we went through that. And anyway, send us a line if you have any queries. But in the meantime, please, can you press like and subscribe to the channel? And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website, or to any information, products, services, or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.